Let me begin with a simple but uncomfortable truth. When a small market begins to behave in a way that exposes deep stress in a very large system, it is never just a market story. It is a signal, and today silver is sending exactly that kind of signal, quietly, steadily, and in a way that most people have been trained not to notice. History teaches us that systems rarely collapse all at once. They fracture first in places that seem secondary. Silver is one of those places. For decades, we were told that silver was boring, insignificant, a side commodity. Gold mattered, stocks mattered, bonds mattered, silver was treated as noise. But here's the problem with that narrative. Silver is deeply embedded in industry, energy, technology, and monetary hedging. When silver stops behaving the way the system expects it to behave, it is not silver that has changed. It is the system revealing its limits. Silver's recent behavior cannot be understood as ordinary market volatility or speculative enthusiasm. What we are observing is a deviation from long-established patterns that once governed how this market responded to interest rates, industrial demand, and broader financial cycles. When an asset repeatedly refuses to move according to the models designed to explain it, economists must ask a deeper question. Is the asset behaving irrationally, or is the system itself under stress? Increasingly, the evidence points toward the latter. Silver is not malfunctioning. It is revealing pressure points that have been building quietly within the financial architecture for years. Modern financial systems depend heavily on predictability. Prices are expected to respond smoothly to policy signals, liquidity injections, and forward guidance from central institutions. Silver's recent actions challenge that expectation. Despite official narratives of stability, tightness in physical supply, rising premiums, and delivery delays suggest a market that is far less balanced than paper prices imply. This contradiction is not trivial. It exposes a structural weakness where financial representations of value are drifting away from material reality, a condition that historically precedes broader instability. The silver market occupies a unique position because it bridges monetary symbolism and industrial necessity. It is embedded in energy systems, electronics, medical technology, and infrastructure, while simultaneously serving as a monetary hedge during periods of uncertainty. When stress appears in such a market, it rarely remains contained. The tension between financial contracts and physical availability becomes a diagnostic tool, signaling whether a system built on leverage and confidence can still function smoothly under strain. One of the most revealing aspects of this moment is how little attention it receives in mainstream discourse. Significant structural stress often announces itself indirectly through anomalies that seem too small to matter. That is precisely why they are dangerous. Financial history repeatedly shows that major disruptions begin not with dramatic crashes, but with subtle breakdowns in trust and coordination. Silver's behavior suggests that the mechanisms meant to smooth volatility are losing their effectiveness, not because of mismanagement, but because they are being pushed beyond their structural limits. This development forces a reconsideration of how value is produced, represented, and defended within contemporary capitalism. When paper claims grow faster than the physical resources they reference, tension becomes inevitable. Silver is now reflecting that tension in real time. The market is sending a message that can be ignored, dismissed, or explained away, but not erased. For those willing to look beyond surface-level price charts, silver is functioning less as a commodity and more as an early warning system, revealing stresses that are systemic, cumulative, and increasingly difficult to contain. The growing separation between paper markets and physical silver is not a technical anomaly. It is a structural tension that strikes at the core of modern financial organization. Paper markets were designed to provide liquidity, efficiency, and risk management, allowing participants to trade claims on future delivery rather than the metal itself. This system functions smoothly only as long as confidence remains intact. The moment participants begin to question whether those claims can be honored under stress, the abstraction reveals its fragility. Silver is now forcing that question into the open, not through dramatic headlines, but through persistent inconsistencies that refuse to disappear. In theory, futures prices should reflect underlying physical conditions. In practice, paper volumes in silver markets exceed the amount of deliverable metal by multiples that would be considered unsustainable in most other sectors. This imbalance has long been tolerated because few participants demanded actual delivery. Yet when industrial demand rises, supply chains tighten, or geopolitical uncertainty increases, that tolerance erodes. Premiums on physical silver begin to rise, even as official prices signal calm. This is not merely a pricing discrepancy, it is a signal that the mechanisms connecting financial promises to material reality are weakening. What makes this moment particularly significant is the behavioral shift it represents. Investors and institutions are not simply trading price movements, they are reassessing counterparty risk. The question quietly circulating through the market is no longer what is silver worth, but will the system deliver what it promises? Once that question takes hold, it alters incentives across the entire structure. Paper contracts lose their assumed neutrality, and physical possession regains importance, not as speculation, but as verification. This divergence also exposes a deeper contradiction within financial capitalism. The expansion of derivative markets has allowed enormous growth in nominal wealth without a corresponding expansion in real productive capacity. As long as confidence holds, this abstraction appears efficient. When it falters, the distance between claim and commodity becomes visible. Silver, because of its dual role as an industrial input and a monetary refuge, sits precisely where this contradiction becomes hardest to conceal. History offers a consistent lesson. Systems built on layered promises remain stable only until enough participants attempt to convert promises into reality at the same time. Silver's current behavior suggests that conversion pressure is rising, even if quietly. The gap between paper and physical markets is no longer theoretical, it is operational. That gap is where trust is tested, where stress accumulates, and where the early stages of systemic recalibration begin to unfold. Monetary expansion was once described as an emergency response, a temporary intervention designed to stabilize economies during extraordinary circumstances. Over time, however, it has become normalized, institutionalized, and expected. Trillions in newly created money have flowed through financial systems with the assumption that liquidity itself could substitute for structural reform, and this assumption is now being tested. Silver's behavior reflects a growing discomfort with the idea that value can be endlessly manufactured without consequence. When monetary expansion accelerates faster than real economic growth, confidence becomes the most fragile variable in the system. Central banks operate on credibility. Their power does not come from physical production, but from collective belief in their ability to manage outcomes. As balance sheets expand and interest rates are repeatedly manipulated, that belief weakens incrementally rather than dramatically. The public rarely reacts to the first signs of erosion. Instead, skepticism builds quietly, often expressed indirectly through behavior rather than protest. Rising interest in tangible assets, such as silver, is one such expression. It signals a search for anchors in an environment where monetary signals feel increasingly abstract. The critical issue is not inflation alone, but uncertainty. Monetary expansion blurs price signals, making it difficult for individuals, firms, and institutions to distinguish between genuine growth and liquidity-driven distortions. Silver, because it exists outside the credit system while remaining essential to industrial production, becomes a reference point when trust in monetary stewardship declines. Attention shifts toward assets that do not depend on policy credibility for their existence. This shift is subtle, but it is deeply consequential. Another layer of tension emerges from the distributional effects of monetary expansion. Liquidity does not spread evenly through an economy. It concentrates first in financial markets, inflating asset prices while wages and productive investment lag behind. This divergence fuels inequality and social strain, further undermining confidence in the system's fairness and sustainability. Silver's renewed relevance reflects this imbalance. It becomes a hedge not just against inflation, but against a system perceived as structurally tilted toward financial elites. What makes this moment especially revealing is that silver's movement is not driven by panic, but by recalibration. Participants are adjusting expectations in response to long-term policy trajectories rather than short-term headlines. That adjustment suggests a recognition that monetary expansion has limits. Even if those limits are politically inconvenient to acknowledge, silver is responding not to fear, but to fatigue. Fatigue with policies that promise stability while steadily eroding trust. In that sense, silver is not predicting collapse, it is measuring confidence. And the measurement is becoming increasingly uncomfortable for those who rely on belief as their primary instrument of control. But the assumption that markets can always be guided, stabilized, or corrected through institutional intervention has long been central to modern economic management. Control mechanisms such as forward guidance, interest rate adjustments, regulatory oversight, and coordinated messaging are designed to shape expectations and reduce uncertainty. For years, these tools appeared effective, not because they eliminated risk, but because participants believed in their capacity to do so. Silver's recent behavior suggests that this belief is weakening when markets begin to move in ways that resist narrative management. It signals a loss of influence rather than a loss of information. What makes this shift significant is not volatility, but persistence. Temporary dislocations can be managed. Structural ones cannot. Silver's movements indicate that traditional levers are producing diminishing returns. Price suppression through financial instruments, confidence-building statements, and policy reassurance no longer yield the same stabilizing effect. Instead of restoring calm, interventions increasingly appear reactive, revealing strain rather than strength. Markets are highly sensitive to this distinction. Once participants sense that control mechanisms are being used defensively rather than strategically, confidence erodes further. There is also a psychological dimension at work. Financial systems rely on coordination, on shared assumptions about how markets will respond to authority. When those assumptions fracture, behavior changes. Investors begin to test boundaries rather than respect them. Physical demand increases, delivery timelines lengthen, and risk assessments shift. Silver is becoming a space where these tests are visible. The metal is not defying control out of irrationality, but because the structures attempting to manage it are constrained by contradictions they cannot resolve. Control mechanisms are also limited by political and institutional incentives. Policymakers must balance market stability against credibility, growth against inflation, and intervention against restraint. These trade-offs narrow the range of effective action. When a system is highly leveraged and deeply interconnected, even small adjustments can produce unintended consequences. Silver's behavior reflects this narrowing margin for error. Each attempt to reinforce stability reveals how little flexibility remains. Perhaps the most revealing aspect is the growing reliance on silence rather than explanation. When control weakens, transparency often declines. Markets notice. The absence of clear guidance creates a vacuum that participants fill with their own interpretations. In such an environment, tangible assets gain prominence not because they promise extraordinary returns, but because they offer certainty. Silver's refusal to remain subdued suggests that the tools designed to contain market behavior are approaching their functional limits. What we are witnessing is not a failure of management, but a structural reality asserting itself against a system increasingly dependent on perception rather than capacity. The hulls. Silver has historically played a subtle but revealing role during periods of economic transition. Not as a driver of crises, but as an early indicator of underlying stress. Unlike assets that react loudly and immediately to headlines, silver tends to move when deeper structural pressures accumulate. That is precisely what gives it significance. Now, when silver begins to behave independently of official expectations, it suggests that tensions are developing beneath the surface of the financial system, long before they become visible in broader markets. This is what makes silver dangerous to ignore and valuable to understand. What sets silver apart is its dual identity. It is both a monetary asset and an industrial necessity. It responds to shifts in confidence as well as changes in production, technology, and energy demand. Because of this, silver absorbs information from multiple parts of the economy simultaneously. When these signals begin to align, they form a composite warning. The current alignment suggests that financial confidence, supply chain resilience, and institutional credibility are all being tested at once. That convergence is rare, and when it occurs, it has historically preceded major economic adjustments. Markets often misinterpret early warning signals because they do not fit conventional narratives. Silver does not dominate headlines, nor does it carry the symbolic weight of equities or sovereign bonds. Yet this marginal status is precisely why it functions so effectively as a diagnostic tool. Stress tends to surface first in areas where oversight is lighter and expectations are lower. Silver operates in that space. Its recent behavior reflects a system struggling to reconcile paper-based financial expansion with real-world constraints. Another critical element is timing. Systemic warnings do not announce themselves with certainty. They appear as probabilities. Silver does not predict outcomes, but it reveals direction. When participants begin to treat it less as a speculative instrument and more as a signal of imbalance, the market's role changes. Demand becomes less reactive and more intentional. This shift indicates that actors are preparing rather than reacting, adjusting their exposure in anticipation of future instability rather than immediate disruption. What makes this moment especially compelling is the absence of panic. Silver's warning is calm, measured, and persistent. That is often the most credible kind. Economic history shows that the most damaging crises were preceded not by hysteria, but by complacency. Warning signals were present, but dismissed as noise. Silver's current role challenges that pattern. It suggests that stress is building slowly across institutions and markets in ways that cannot be easily reversed through conventional policy tools. The signal is not urgent in tone, but it is serious in implication, inviting those paying attention to reconsider assumptions about stability, resilience, and control within the global financial system. The disruption visible in the silver market should not be interpreted as an isolated malfunction confined to one commodity. Treating it that way would be a serious analytical mistake. Markets do not exist independently. They are interconnected expressions of a broader economic structure. When stress appears in one area and persists despite interventions, it often reflects pressures distributed across the system as a whole. Silver's behavior is drawing attention not to its own importance, but to the fragility of the mechanisms that govern global finance. Modern economies are built on leverage, interdependence, and expectation. Credit links households to banks, banks to governments, and governments to global capital flows. This architecture functions efficiently during periods of stability, but it is inherently sensitive to shocks. When leverage is high and margins for error are narrow, even modest disruptions can have outsized effects. Silver is revealing this sensitivity. Its movement suggests that the system's tolerance for imbalance is shrinking, not expanding. What makes systemic fragility difficult to recognize is that it rarely announces itself through a single dramatic failure. Instead, it emerges through accumulation. Debt grows faster than productive capacity. Financial instruments multiply faster than underlying assets. Risk is dispersed until responsibility becomes unclear. In such an environment, markets that sit slightly outside the core often respond first. Silver, positioned between industrial production and monetary confidence, absorbs stress from both directions. Its instability reflects tensions that are already present elsewhere, even if they remain temporarily contained. Another indicator of systemic weakness is the declining effectiveness of diversification. Assets that once moved independently are increasingly correlated during periods of stress. This suggests that risk is no longer localized, but embedded across the structure. When silver begins to move in ways that contradict official signals, it implies that traditional risk management assumptions are being challenged. Participants are no longer confident that the system can compartmentalize problems, and that realization changes behavior across markets, not just in commodities. Perhaps the most revealing aspect is the reliance on reassurance rather than resolution. Systems under strain often prioritize maintaining confidence over addressing root causes. Short-term stability is achieved at the expense of long-term resilience. Silver's persistence undermines that strategy. It cannot be easily reassured, deferred, or negotiated with. It reflects material constraints that policy cannot suspend indefinitely.